The Fed has cut interest rates 7 times since September 2024. Your mortgage rate is still 6.43%. Something isn't adding up. And the answer isn't in Washington. Hassan clocks in at 5 a.m. He tightens the same valve he's tightened 10,000 times. A tanker fills. He drives home. He has no idea what currency just changed hands. Neither do most Americans. That's the problem. If you have a $400,000 mortgage, or you're trying to get one, what happens in Riyadh directly affects what you pay every month. By how much exactly? We'll get there. But first, you need to understand something the Fed itself doesn't want to admit out loud. The Fed controls short-term rates. Everyone knows that. What almost nobody explains. The Fed has zero control over the 10-year Treasury yield. Zero. And your mortgage rate doesn't follow the Fed. It follows the 10-year Treasury. Always has. Before we go further, here's exactly what this is built on. IMF's currency composition of official foreign exchange reserves, US Treasury International Capital data, and the Mortgage Bankers Association report from 5 days ago. Every number I use has a source. I'll tell you what I don't know too. 1974. A secret deal. Saudi Arabia prices oil in dollars only. In return, American military protection. The Saudis take those dollars and buy US government debt. That buying pressure kept Treasury yields artificially low for 50 years. Which kept your mortgage artificially low. Dollar share of global reserves in 2001, 72%. Today, 57.8%. The slide took 25 years. Most people still haven't noticed. June 9th, 2024. No press conference. No emergency Fed meeting. The 50-year Petrodollar agreement between the US and Saudi Arabia quietly expired. Most financial media covered it for 2 days and moved on. Here's what they missed. Same week the agreement expired, Saudi Arabia joined Project mBridge, a digital payment system that bypasses SWIFT entirely. They also signed a $7 billion currency swap with China. They didn't leave the dollar. They built a door, and they left it open. That distinction is everything, and it's exactly why your mortgage rate isn't coming down the way the Fed promised. In 1974, a US Treasury Secretary flew to Riyadh with one goal: make sure America never had to compete for its own debt buyers. It worked. For 50 years, June 9th, 2024, it stopped working. Here's the mechanism. Let me draw the chain that kept America's borrowing costs low for half a century. Old system. Saudi sells oil, receives dollars, buys US Treasury bonds. Simple, elegant, and incredibly powerful for America. New option. Saudi sells oil to China, receives Yuan, converts excess Yuan to gold on the Shanghai Gold Exchange. No dollars, no US Treasuries. The chain breaks. Here's what that break looks like in real data. Foreign official Treasury purchases, the category that includes Saudi Arabia, have been declining as a share of total US debt financing. Now, here's where it gets complicated, and this is where most coverage gets it wrong. Saudi Arabia's Treasury holdings actually increased $26.8 billion in the past year. They're still buying, but at the exact same time, they joined a SWIFT bypass system, signed a $7 billion Yuan swap, completed their first Yuan oil transaction. They are buying dollars with one hand and building the exit with the other. This is not defection. This is the most sophisticated hedge in geopolitical history. Saudi Arabia is positioning itself to benefit no matter which system wins. Now, the Fed has cut rates 175 basis points since September 2024. Under every historical model, mortgage rates should have followed. They didn't. The 10-year Treasury yield is sitting at 4.39%. The Fed funds rate is at 3.5%. That gap, 89 basis points, is historically abnormal. Something is holding yields up that the Fed cannot push down. Federal Reserve's own research is specific about this. A $100 billion shift in foreign official Treasury purchases moves the 10-year yield by approximately 100 basis points. Saudi Arabia holds $143.9 billion. The math is uncomfortable. What does 100 basis points mean to you? On a $400,000 mortgage, $270 more. Every month, $3,240 every year. For 30 years, that's $97,200 in extra interest payments. From one geopolitical shift most Americans can't even pronounce. And here's the third-order effect nobody is modeling. Higher mortgage rates don't just cost existing homeowners more. They freeze the entire housing market. Sellers won't move because they'd lose their 3% pandemic-era rate. Buyers can't afford to enter. The housing market isn't slow because of the economy. It's frozen because of a valve Hassan tightened at 5 a.m. in Saudi Arabia and a currency decision made in Beijing. The Fed can cut rates 10 more times. It won't fix this. Not alone. Someone signed a mortgage document this week at 6.43%. They blamed the Fed. They were wrong about who to blame. That's not how it works. And that misunderstanding is exactly why nobody saw this coming in their own finances. The real connection runs through a node almost nobody talks about. Not the dollar's value, not oil prices. Who buys US government debt? That's the variable that controls your mortgage rate. Every time Saudi Arabia takes oil dollars and buys US treasuries, they are directly subsidizing American borrowing, including yours. That subsidy has existed since 1974. Now that dot is splitting. Some dollars still flow to treasuries, but some yuan flows to Shanghai, to gold, to Chinese financial infrastructure. The subsidy is shrinking, not gone, shrinking. Here's the signal most investors missed entirely. Central banks bought 2,082 tons of gold in 2023 and 2024 combined. The previous annual average from 2010 to 2021, 473 tons. That's not diversification. That's preparation. Who's buying? China, Russia, India, Turkey, Poland. Every country that has either faced US sanctions or fears them. They are not buying gold because they like gold. They are buying gold because they don't trust the system that makes your mortgage rate what it is. When the US sanctioned Russia in 2022, froze $300 billion in reserves. Overnight, every other country watched and quietly started asking, what if that was us? Saudi Arabia was in that room. They saw exactly what dollar dependency looks like when the relationship turns. Here's the paradox buried in the data. The more aggressively America uses the dollar as a sanctions weapon, the faster every other country builds the exit door. Using dollar dominance to punish enemies is slowly destroying dollar dominance itself. That's not opinion. That's what the IMF data shows. So the hidden connection isn't really about Saudi Arabia. It's about what happens when the entire architecture of dollar demand starts shifting slowly, quietly, without a single announcement. The 10-year Treasury yield doesn't need a crisis to rise. It just needs fewer buyers. And right now, it has fewer buyers. That's why your rate is 6.43% and not 5%. Let's talk about the paradox directly. The Fed has done everything it's supposed to do, cut rates 7 times, signaled more cuts coming, and mortgage rates went up anyway. Not sideways, up. The 30-year fixed hit 6.43% highest since October. That gap between what the Fed controls and what your mortgage tracks is now 89 basis points wider than historical norms. In every Fed cutting cycle since 2001, mortgage rates followed within 60 to 90 days. 2001, 2007, 2019. Every single time the pattern held. 2024. The line doesn't move. For the first time in modern history, the mortgage market has decoupled from Fed policy. Something structural has changed. And it happened the same year the Petrodollar agreement expired. The spread between the 10-year Treasury yield and the 30-year mortgage rate normally sits between 150 and 200 basis points. Today, it's 205. That extra spread reflects one thing: lenders pricing in structural uncertainty. They don't know who's going to buy US debt next year, so they charge you more. Here's the math your lender runs but never explains. 10-year Treasury yield, 4.39%. Risk premium for uncertainty. Prepayment risk. Market volatility, 205 basis points. Total, 6.43%. That risk premium is the part Saudi Arabia influences, not the Fed. And here's the layer underneath the layer. The US government needs to sell $1.94 trillion in new debt in fiscal year 2026 alone. Every dollar of that debt needs a buyer. Fewer petrodollars recycling means the US has to offer higher yields to attract other buyers, which pushes your mortgage rate higher. The deficit and the petrodollar shift are compounding each other. Meanwhile, China gets something extraordinary from this arrangement. They buy Saudi oil in Yuan, their own currency. No conversion cost. No dollar exposure. Their manufacturers pay less for energy than American competitors. That cost advantage compounds every quarter. So here's the full paradox. America uses dollar dominance to sanction enemies. Those enemies and their allies build alternative systems. Alternative systems reduce Treasury demand. Reduced Treasury demand raises your mortgage rate. The weapon is slowly wounding the country that built it, and the people paying the price aren't in Washington. They're trying to buy a house in Ohio. Let's make this personal. At 6.43%, a $400,000 mortgage costs you $2,500 a month. If the 10-year Treasury yield rises another 50 basis points, which Wolf Street and Bankrate analysts are both modeling your rate climbs towards 7%. That's $270 more every month. That $97,200 in extra interest payments over 30 years is more than the median American retirement savings. You're not just paying more for a house. You're paying your retirement into a geopolitical shift you never voted for. Here's what the next 12 months likely looks like based on current trajectory. 6 months out. Saudi strategic hedging continues. No dramatic move either direction. Treasury yields stay elevated. Mortgage rates hold between 6, 5, and 7%. The freeze continues. 43%. 43% of American millennials have permanently given up on homeownership. Not paused, given up. That number was 21% in 2019. This is what a structural rate shift looks like in human terms, unless one of 3 things changes. Let me show you what to watch. 3 scenarios. Real probabilities. Based on S&P Global Research and Federal Reserve structural analysis. Worst case. 20% probability. Saudi Arabia formalizes Yuan oil pricing within 3 years. Dollar loses another 5 to 8 points of reserve share. 10-year Treasury yield climbs above 5.5%. Mortgage rates hit 7.5 to 8%. The housing market doesn't slow. It seizes. Most likely scenario. 60% probability. Saudi continues strategic hedging. Some Yuan deals. Mostly dollars. No dramatic shift. Dollar reserve share stabilizes near 55 to 57%. Mortgage rates stay between 6.5 and 7% for 2 to 3 more years. Not a crash, just a long, painful freeze for anyone trying to enter the housing market. Best case. 20% probability. The US and Saudi Arabia negotiate a new security framework. Dollar recycling continues. Treasury demand stabilizes. Mortgage rates drift back towards 6% by late 2027. Not great, but breathing room. Plan for the most likely scenario. Not the catastrophe. Not the rescue. The slow grind. That's what the data actually supports. Nobody is going to call you about this. No bank. No advisor. No government agency. So here are 3 things you can do starting tonight. 1. Stop watching Fed announcements. Start watching the 10-year Treasury yield. That number, not the Fed funds rate, is your actual mortgage predictor. It's public. It updates daily. Bookmark it. 2. If you're in an adjustable rate mortgage, run the numbers on locking in now, before further yield volatility. A fixed rate at 6.5% is painful. A variable rate at 8% in 2 years is worse. 3. If rates drop to 6% or below, refinance immediately. Don't wait for 5%. That window, if it opens, may last weeks, not months. The structural pressure on yields is not going away quickly. Sources are linked in the description. IMF COFER database, US Treasury International Capital data, Mortgage Bankers Association, Federal Reserve research on foreign official treasury flows, S&P Global Petro-Yuan structural analysis. I cross-referenced 5 independent datasets. verified every number against primary government sources. This analysis is built entirely on public data. Here's what I don't know and can't know. The exact volume of Saudi-China Yuan transactions, that data is not public. What's being negotiated behind closed doors in Riyadh right now? Whether Project mBridge scales fast enough to matter in the next 3 years. Who's been protecting your mortgage rate? Not the Fed. Not the Treasury. For 50 years without telling you Saudi Arabia was. That arrangement is over. And nobody sent you a letter. Hassan is still at the valve at 5 a.m. He still doesn't know what currency just changed hands. But somewhere a number just moved. And in a suburb you've never heard of someone just got approved for a little less house than they wanted, the chain doesn't announce itself. It just tightens.